Good morning, everybody. It's Friday, December 8th, and this is the AgYield War Room. I'm Dan Dempsey, and I'll be moderating today's session. We are coming live from the War Room, which is going to be fun today. We got a couple of really good shows up for you today. As always, if you've got any questions or comments, please feel free to drop those in the chat area, and we'll get to those during the show. Real quickly, overnight markets had January beans finish up 11 at 13.22 3/4. March corn was up 1 3/4 at 4.89 3/4, and March Chicago wheat was down 3 3/4 at 6.38.5. Quite a bit of data out here this morning. We had sales announcements of 136,000 soybeans to China for 23, 110,000 soft red winter wheat to China for 23, and 165,000 corn to unknown for 23. Jobs data in the outside market came back better than expected. 199,000 jobs added versus they were looking for about 190,000. And the unemployment rate unexpectedly fell to 3.7%, looking for about 3.9. That's gotten the dollar to rally sharply this morning, and bonds are breaking pretty good. One interesting note on the jobs report that I thought was interesting anyway, retail lost 38,000 jobs, and half of those came from department stores. So I think it kind of plays into the old Amazon generation, right? And brick and mortar doesn't seem to be the play anymore for folks. Big day today. We've got USDA report coming out at 11 o'clock. I think that's going to consume most people's thoughts. I wanted to kick it to the group and just see, what number, if any, are we really targeted in on in watching closely today? I know historically we were talking before the show. Does the USDA has never really bumped or jumped, broken yields in December. And I'm not sure if that's a standard or if that's just something that they've done. So I'll kick it over to the boys and talk about that a little bit.
Yeah, I think the obvious one's going to be the South America crop numbers. I don't think anyone's expecting much from the U.S., changes, which they don't historically make, until the January report. So it's going to be, what the Brazilian, crop numbers come in at. So my opinion.
Yeah, I think the market's going to be interested in what the USDA has to write down. I think they, CONAB took their Brazilian production down towards 160, and the USDA is still at 163. So, historically, they don't usually start to lower those too much in the December report either, unless there's an obvious problem. So if they were to go print another 163, that wouldn't be unusual for them. Right. The question really is, does the market really care? It's just the USDA economist's opinion.
So I noticed too, Argentine crop conditions actually improved. They're saying that 98% of the bean crop is considered to be normal to excellent conditions. So it kind of fits what we've been talking about, right? It's early, things still got a long way to go.
Well, it's a big country, it's a big continent, right? So, right. Argentina looks good. Mato Grosso is where they're kind of focusing on the dryness areas in Brazil. So, Argentina got hammered last year. I think their yield was down 50-60% normal. Argentina looks pretty good right now. It's Brazil that's having some issues. So I think Mato Grosso is going to be the one that everyone focuses on, getting rain or not.
Well, and Brazil will have an issue first, right? As far as maturity goes, the way I think about it, and correct me if I'm wrong, but north to south, right? Kind of like opposite of this country, right? Like you'll have earlier planted up north. So the way I think about it, right, is like, depending on the weather, north is dry, like we might trade that first, or like a later season dryness in Argentina could be a problem.
Excuse me.
Yeah, I was looking at the 6 to 10 for Brazil. Looked pretty enticing here. It looks like the rain showers should be coming in. Private analysts have, bean planted at a 76% on the Brazilian beans. Last year I think it was 87. So you're behind schedule a little bit, but the forecasts are looking pretty favorable.
Seems like they were looking for rains.
Yeah.
What it sounds like, and there's been a lot of chatter, and I don't know if anybody can answer it, but there's been all the social media buzz about people tearing up soybean fields and planting cotton. I don't know if that's true or if it's just somebody trying to gain some traction on social media. But there's been I've seen it several places. I have no idea if it means anything.
They probably, I'm sure it's happening, but it's kind of like this country where we'd love to show the same field over and over again.
Right.
It's fine.
Yeah.
Find the one case and act like it's on,
That's widespread.
millions of hectares. It's just not.
Yeah.
Right. I
Very
think I
much
saw
so.
the same, drought Missouri cornfield 35 times this
Yeah.
So,
Maybe even from a couple of years ago too.
Right.
So,
right. It's just hard to know anymore.
yeah.
Guys,
Well-
it was interesting this morning, talking about, and I know we're moving around a little bit just because, like I said, kind of a slow news morning as we go to court, but let's talk about this LRP thing. A lot of stuff circling about, this really big breaking cattle and how the LRP game fixing this market, whatever. And talk about the fundamentals about that. Like what in our mind, like what did the reinsurers do, and talk through some of the dynamics behind how that all plays out on the insurance side.
Well, I mean, like, I don't know exactly how they're hedging their position based on what they're selling. You would assume, Dustin and I talked about this a couple of times, what we would assume we would do if we were in that situation to keep a delta neutral position in the market, which could have been justification for some kind of a break. But really what we saw, and I think what a lot of people saw, was a liquidating market. And a lot of focus is on LRPs as being kind of some demon in the market that's just going to crash prices, that it's the insurance companies. And there's been a lot of, I would say, chatter about these companies not able to handle the potential indemnity payments that they would have to have because of how deep in the money a lot of these are going. But it's the way that the structure of the market is. I don't think that there's enough LRP really to crash the market, essentially, just because they're in the money. I just, at least from my knowledge of what it is and how it's used. I mean, like, we understand that there's put options in the corn market and bean market, and it doesn't make it seem like just because it gets to those levels, somebody's got to go hedge that side of the position to make it crash like that. So what we saw really was the dynamic of the futures market coming off a record high price. And we saw managed money liquidating. We saw producers selling into this. We saw the speculative long bailing out of this market at just a very fast pace. It didn't suggest that insurance companies were dogpiling into this market, adding to these shorts. That was not what the data would suggest. So, I mean, we know that the LRPs are on a weekly basis. A lot of these LRPs are going to be, their indemnity is not coming until, I mean, we're talking February, March, April, May timeframe. It's just a matter of how many weeks. So, like, it doesn't make a lot of sense.
Like, it's the boogeyman.
Yeah, right.
I mean, go look at any commodity market over the last 100 years. Like, they go up and then they top.
Right.
At some point, we're coming off all-time highs. Like, you have to blame somebody that we broke.
Right.
I mean, it's just, it's go look at orange juice, go look at any big commodity. Canada's coming off all-time highs.
Absolutely.
I think my big point here too is that these are large multinational reinsurance companies, right? With, I mean, floors and floors of risk management folks working, right? This isn't new to their books and things like that, right?
It's hedging. It's literally a subsidized put. It's the most straightforward hedge you could possibly make.
Right.
I mean, look at like RP for crop. You have to think of yield and price. This is just price. Like, it's the easiest thing in the world to hedge, and it's subsidized. So I'm guessing the people that are mad about LRPs are the ones that don't own them.
Yeah, and exactly. I think there's a lot of jealousy going on, or just FOMO, because we were sitting at record high prices, and a lot of the talk was surrounding, it's like when corn's at $7, we're going to start talking $10 corn,
Right.
or beans are at 13, we're going to start talking $20 beans. It's just that those numbers are going to get thrown out there. And so when you're talking about, $2 live prices and people really have that dollar sign in their mind, it's really tough to sell the market, especially when every single person around you is telling you how tight this is, and this ain't going to we're not going to replenish this supply for another 2 years. It's just the way I think just a lot of the mentality goes. But there's hands down, there's a ton of FOMO right now. And there's a ton of losses that are potentially on the table too from producers that didn't hedge. I mean, there's still some really nice feeding margins. They're just not what they were,
Well, that's
not unique. I mean, that's not unique to cattle, right? Like,
No,
we just talked about this in corn, right? We just hit 3-year lows on first notice day, right? So, all these people that didn't sell it because the drought, they want to blame somebody too.
Right.
Blame the WASI or the government.
Well,
Go ahead, Ben.
I think that a lot of times people try to simplify the market and justify a reaction. And the complexity of our markets with algorithms, speculative money, end users, producers, people that are putting on intercommodity spreads, you can't justify every single move in space and in time. Ultimately, the fundamentals will win out and you will find the right price. And on any given day, whether you're a producer and end user and you see a price that appeals to you, that's where you have to take action. If you try to quantify every single move in your head, you will make yourself crazy and you will miss the bigger picture of what's going on, which is what you should or shouldn't be doing.
Right. And there's plenty of data to back up a lot of what is happening in the market at every time. We stare at it all day long. But I do think especially when it comes to the cattle market and the beef market, one of the things that has been, and I think all of us here would probably be on the cautious side of just about anything because of the potential threat of recession or, some kind of, downward facing economic headwind. Jobs report, wage growth. These are things that are directly related to beef and that kind of flow. And like we're seeing retail meat prices still at unbelievably, possibly record high prices in a lot of markets. It does need a correction. We need to move more tonnage. And we already know that on a consumer level, there's been a lot of concerns. I mean, I think the jobs report was a little bit of a fresh air for the cattle market, at least with it looked like average hourly earnings were up 0.4% in November. So, I mean, like there's an ebb and a flow to a lot of this data. And, when the market finally corrects, it's not to say that it can't bounce back. I mean, I think a lot of people want to stay hopeful. It's just gone so much further down so fast. And I think now people are just looking at their budget sheets. They're looking at what they have hedged, and they're like, "Man, I wish I had done this."
This is the argument about people that hedging when you're at these kind of prices. Like it turns so fast anymore.
Right.
To Ben's point about the type of participants that we have in our markets, like algos, they're literally programmed to sell it when it turns down,
right,
or buy it when it turns up. They don't care about waiting to see how the report comes in or. Well, once those numbers cross, they go, and they got a lot of money and they got a lot of speed.
Yes.
And I think that just catches traditional hedgers, traditional, players off guard a lot. Like, look how big these moves are. Well, these are big boy markets. When you're at all-time highs and you've got lots of money flowing in, the same people that you want to praise when you're at all-time highs, you're going to want to curse when you have these big breaks.
Absolutely.
The same players though.
Yeah.
So we get through the report today. I'd say that, for this time of year with China being in for wheat and different things happening that way, you've got this drying discussion in Brazil and whatnot. Would you say we're going to go into thin markets with a lot going on, right? I mean, the next couple of weeks, because what are we, 2.5 weeks out from Christmas or thereabouts? I mean, it's going to get pretty dry in there for what's going on. You flip a weather map, and who knows what.
Well, that's what I was going to say. I know Justin talked about, the 200-day moving average at about 527-ish. Putting price targets in, I think, is important.
For March corn, you're saying?
Yeah, for March corn, excuse me. Yeah. 501.25 is a 100-day. 527.25 is a 200-day. 493.75 is a 50-day. So just having target orders in place, I think, is important.
They could just try that for no reason because it's Tuesday and there's nobody around.
Right.
I mean,
So just having orders in place.
Never forget.
Well, you've got, you're going into a seasonal where you tend to rally between now and March, right? And whether we're bearish enough this year where that doesn't happen, I don't know. But to that point, like you've got seasonals in your favor, you've got a big fundamental or a big hedge fund short in corn and wheat. I think you've obviously been covering some in wheat. You saw what happens when they start to cover, rallies $1 pretty quick in wheat. So I think it feels to me like you're trying to carve out some kind of a seasonal low here. Obviously we can fail and go make new lows. That's, nothing's in stone, but it feels like we're trying to. We're kind of breaking into business. Corn sales have picked up. Obviously, we've broken into some wheat demand. Bean demand's been pretty good here. Still some uncertainty in Brazil, obviously. So, maybe we've done enough breaking for now, and see what happens between now and New Year's, my opinion. But.
Would be a good reprieve too. You know, if you could catch some of those moving averages, and just be a nice way to get some stuff cleaned up for old crop. And and like we've been talking about too, I mean, we can't turn a blind eye to 24 with tight margins, and something does happen and you catch something goofy in the back. I mean, how many times have we seen that, right? Like, why is December 24 corn up 8 cents, or something like that, right?
Yeah.
And who knows what that means for anybody's margin. It could be something different for everybody, but taking a look at it. Gentlemen, I know we're going to be live at 11:05 Central today. Same place here, right from the war room. We're going to talk about USDA report and what we see in that. And then also, next week, same time, same place, 8:15 Central Time, streaming live now on YouTube, Facebook Live, and X. We're going to be coming into the open here. Looks like we've got Jam Beans up 14 now, 13.25 3/4. They got March corn up 1 3/4 pennies, 4.89 3/4, and March Chicago wheat's up 1.5 pennies at 6.44. Appreciate everybody tuning in this morning, and we'll see you here in a little bit after the report.
Thanks, Jim.
Thanks, Dan.